Let's start with a clear warning. All trading involves risk. Forex and CFDs, they dial that risk up through leverage, which means you can win big or lose big and fast. Statistically, 70 to 90% of retail traders lose money in these markets. So, protect yourself. Master the basics with demo accounts. Build a risk strategy, and never ever trade money you can't afford to lose. Remember, past performance is not a promise for the future. What's Forex? It's the world's biggest market, over $7 trillion traded every single day. But most modern traders don't buy stacks of currency. They use CFDs or contracts for difference. Think of these like side bets on currencies, stocks, crypto, or even oil, without ever owning the actual asset. No physical exchanges, just 24/5 online trading. Tokyo, London, New York, all lighting up around the globe. So, why trade Forex or CFDs? Well, there's opportunity. 24-hour access, high liquidity, and leverage, which lets you start small and control big positions. But here's the catch. Volatility and leverage can also explode your losses just as quickly. This is why I always recommend start small, set stop losses, and don't risk more than 1 or 2% per trade. Who are the big players? Banks, hedge funds, and central banks are the whales. Retail traders like you and me join through brokers, who provide the trading platforms and access to leverage. Just remember, your broker profits from the spread between buy and sell prices, not from your losses directly. Let's decode currency pairs. All currencies trade in pairs, like EUR/USD. The first currency is the base, that's what you're buying or selling. The second is the quote, telling you the price. The bid is what you get if you sell. The ask is what you pay to buy. The difference, that's the spread, and it's your broker's fee. Go long if you think the base rises, go short if you think it'll fall. Leverage and margin, here's where things get interesting. Leverage lets you control, say, $100,000 with only $1,000. That's a 100-to-1 ratio. Margin is your deposit, the safety net. If losses pile up and your margin runs low, you get a margin call. Ignore it, and your broker will close your trades to protect themselves, not you. You can lose your whole deposit, but never more. Timing matters. The market runs in 3 main sessions: Asia, London, and New York. Asia is quieter, best for AUD or JPY. London is volatile, where major pairs make big moves. New York brings action to USD pairs, oil, and stocks. The best trading, when London and New York overlap, the market is buzzing. Orders, 2 main types. A market order buys or sells instantly, but sometimes at a slightly worse price. Pending orders let you set your price in advance, either above or below the current market. Always use a stop loss to limit risk, a take profit to lock in gains, and a trailing stop to follow rising prices. To recap, Forex and CFDs are high risk, high reward. Use leverage carefully, trade major pairs for tight spreads. Always use stops. And please, start with a demo account. Learn risk-free before you ever put money on the line. Ready? Practice makes profit. Take your time and trade smart.